Hi guys, and welcome to Cultnomics. My name is Paul Hanley, and today I'm going to be chatting to you about expansionary and contractionary monetary policy. In this video, we're going to look at the impact of expansionary monetary policy by the central bank on the real economy, on aggregate demand and aggregate supply. And we'll trace this out through looking at first the money market and then the implications for prices and GDP. So with expansionary monetary policy, what we see is that the central bank will increase the money supply in the economy. This would be through an open market purchase of government bonds, which would be an increase in money supply, an outright purchase, or usually a repo agreement over a 7-day period. So the money supply increases, and that means that the money supply curve shifts to the right on our diagram. So if we look at our money market over here, we have money supply and money demand in equilibrium at point A. That's at 5% and 100 billion. And we're now saying that the money supply curve is going to shift to the right. So we can show that with a rightward shift of money supply over here. And we will just put that in. Couple of arrows, money supply shifting to the right, therefore increasing, and we move from point A to our new equilibrium point down here at point B. And what this shows is that the interest rate will fall in the economy and that the money demanded and supplied will increase. So money supply shifting to the right, or money supply increasing in our economy, causes the interest rate in that economy to decrease, as shown in the left hand side money market. Now, the impact on this in terms of aggregate demand is at least twofold. With interest rates falling, that means the cost of borrowing is falling. So households may be more inclined to take out loans for cars, etc., and to buy a house. And also businesses may be more inclined to invest in capital infrastructure, so investment may increase as well. Now, how do we show this over on the right hand side? Well, what we do here is we are going to look at aggregate demand over on the right hand side. We'll show that as a downward sloping line, and we'll say that that represents aggregate demand in the short run. And we'll also put in an aggregate supply curve while we're at it, and we'll say that it's a short run aggregate supply curve, and we will say that it's upward sloping. So a short run upward sloping aggregate supply curve. We have our equilibrium in here as well at point A, where we have, let's say, a price level of 2 and a GDP level of 100. Now, to translate what's happening here into the real economy, into aggregate demand and supply, we know that both C plus I are actually part of aggregate demand. So they are parts of expenditure in the economy. And if they're both increasing, we would expect aggregate demand to increase as well. Well, we can show aggregate demand increasing by shifting the aggregate demand curve over to the right as shown. So that shift is indicated here. We will call that aggregate demand 1 and indicate it as a new curve. And in this case, it produces a new equilibrium point. So at the current price level, here, at the current price level in the economy, the aggregate demand curve shifts over in the short term over to the right. That indicates now that there is excess aggregate demand in the economy, and it puts pressure on prices in that economy. So with excessive pressure of aggregate demand, what happens here is extra prices will act as a signal, and they will entice in more businesses to supply more, which will reduce demand. So that will push up the equilibrium point to point number, we will call that B, and point number C. And what we'll say in this situation here is expansionary monetary policy tends to be inflationary. It tends to increase the inflation rate in the short run, but it can also have a real impact in the economy in the short run, and it can increase the GDP level. So the initial impact is at a constant price level, and then as new signals enter the market and inventory start to reduce for businesses, we'll see that prices are pushed up by the actions of businesses in the economy. So the real effect of monetary policy in the short run can be to increase GDP at the expense of increased prices. Now, we can also show this as a contractionary monetary policy. So if we look at the second model up here, contractionary monetary policy would mean everything goes in reverse. So a central bank is selling government bonds out on secondary markets, in which case the money supply is decreasing. If it is decreasing, this means that there's a leftward shift of the money supply curve. We can indicate this on our money market diagram, and we can show that the money supply curve shifts to the left. So in this case here, a leftward shift of money supply is shown. We will indicate that as money supply 1. What that causes is the interest rate to increase in the economy, let's say 7% here. So as money supply is reduced, the interest rate is increased in the economy. And what we have is, and what we can do is translate that over to our ADAS model. So we start off with aggregate demand 1 and aggregate demand over here. We have a short run aggregate supply curve, which is upward sloping, and that is short run AS1. We will have an equilibrium in the center point here where market's clear, and we will have this as 2% price level, and we will say output level is at 100, so that's point A. Now, with contractionary monetary policy and the interest rate increasing in the economy, what this does is it increases the cost of borrowing, which means that households can borrow less and therefore consume less, and businesses likewise will borrow less and invest less. Because these two elements are a part of aggregate demand, we know that aggregate demand will also decrease, and we know to show that we can show it shifting leftwards. So aggregate demand curve shifts leftwards in our right hand side model, and that means that aggregate demand is over this side here at AD1. We will show a shift leftwards, and at the constant price level, the aggregate demand curve now has shifted over to the left to this point here. What happens is that this opens up a gap in the economy, an output gap between short-run supply and aggregate demand. Now demand is an awful lot lower, so businesses' inventories are going to start increasing. They will need to offload these and get rid of them, and it provides an incentive for them to lower prices. When they lower prices, aggregate demand increases over to the right, and eventually it leads to an equilibrium point C, where the price level is now lower in the economy, so inflation has reduced due to contractionary monetary policy, and that's at the expense of lower GDP. So the price level reduces, which contractionary monetary policy tends to try and achieve, but the real economy also reduces in this case, and that is contractionary monetary policy. I hope you call back to Cultnomics soon. Bye for now.